Everyone wants low risk and high reward. Very few are willing to live the lifestyle required to earn it. Low risk is boring. High reward is rare, and the space between them is filled with waiting, restraint, and discomfort. Most traders want excitement disguised as opportunity. They want action. They want movement. They want to feel involved. And that desire is exactly why their risk stays high and their reward stays small. Low risk is not found in the market. It is created by the trader. It is created by saying no more than yes, by passing on trades that almost fit, by letting moves happen without participation. High reward does not come from forcing trades. It comes from patience meeting alignment. The market does not owe you opportunity. It does not respond to effort. It responds to precision. Most traders think low risk means tight stops and clever entries. That's only the surface. True low risk comes from emotional control, from the ability to wait without discomfort, from the discipline to accept small losses without reaction. If you cannot accept small losses, you will eventually take large ones. If you cannot sit through quiet markets, you will create chaos. High reward requires asymmetry, and asymmetry requires selectivity. You do not find it by trading more, you find it by trading less. The market offers endless temptation. It flashes movement. It creates urgency. But urgency is the enemy of low risk. Every trader who chases believes this trade will be different, that this one is worth the exception, that discipline can wait. And every time they're wrong, capital shrinks and confidence erodes. Low-risk, high-reward trading is not a strategy. It's a mindset. It's knowing that most days offer nothing worth risking money on. It's understanding that survival precedes profit. It's respecting capital like a scarce resource. The market is not dangerous. Your impatience is. If you feel the need to trade, your risk is already too high. If you feel calm waiting, you're finally in control. Low-risk, high-reward trading belongs to traders who are comfortable being inactive, who don't need constant stimulation, who don't confuse movement with opportunity. This is not about being clever. It's about being disciplined. The market rewards those who protect themselves first. Everyone else pays tuition. Low-risk, high-reward trading is not something you discover. It's something you earn. It begins with accepting a truth most traders avoid. The market is not designed to give you opportunity every day. It is designed to test your patience every day. Most traders fail because they believe activity leads to profit. They equate motion with progress. They mistake opportunity for availability. The market is always moving. That does not mean it is always offering advantage. Low risk is not about avoiding losses. It's about controlling behavior. Every trade carries uncertainty, but not every trade carries necessity. The trader who survives understands the difference. High reward only exists when risk is defined before emotion enters the equation. Once emotion is involved, risk expands silently. That's how accounts are damaged, not by one catastrophic trade, but by many emotionally justified ones. Most traders don't take too much risk because they want to. They take too much risk because they feel compelled. Compelled to make money. Compelled to recover losses. Compelled to be right. That compulsion destroys asymmetry. Asymmetry only exists when you are willing to miss trades, when you are willing to let the market go without you, when you are willing to wait for conditions that rarely appear. Rare conditions create high reward. Common behavior creates average results. Low-risk trading begins with restraint, with fewer trades, with strict filters. The market does not care how many hours you watch it. It only responds to how you behave when temptation appears. Most traders know what low risk looks like on a chart. Very few can execute it in real time, because real time includes fear. It includes boredom. It includes impatience. Low risk requires emotional neutrality, and neutrality is trained, not assumed. If you feel pressure to trade, your risk is already compromised. If you feel calm passing on setups, you are protecting capital. Capital protection is not defensive. It is strategic. You cannot compound what you cannot keep. High reward comes from letting winners develop without interference, and interference is emotional. Traders cut winners because they fear loss. They widen stops because they fear being wrong. They add because they fear missing out. Fear expands risk invisibly. Low-risk traders accept small losses cleanly. They do not negotiate with the market. They do not seek revenge. They understand that a small loss is a fee for information. A large loss is a punishment for disobedience. Most traders look for better entries. Few look for better behavior. The market does not punish intelligence. It punishes impatience. Low-risk, high-reward trading is built on waiting for alignment. Structure, timing, context, and emotional readiness. Remove any one of those, and risk increases. The trader who waits feels uncomfortable at first, because waiting forces self-awareness. You begin to notice impulses, the urge to click, the desire to be involved. Those urges are expensive. The market will always offer excitement. It will rarely offer edge. High-reward trades are obvious in hindsight because they are rare in real time. They feel slow. They feel boring. They do not demand action. The impatient trader cannot hold them. They interfere too early. They exit too soon. High reward requires endurance. You must endure uncertainty. You must endure boredom. You must endure being wrong without reacting. Low risk is not about being conservative. It's about being selective. Selective traders last. Reactive traders don't. Every overtraded day increases risk without increasing opportunity. Every unnecessary trade dilutes focus. The market rewards clarity. Clarity comes from restraint. Low-risk traders understand that missing a trade costs nothing. Taking a bad trade costs capital and confidence. Confidence is fragile. Once damaged, decision-making deteriorates. That's why low-risk traders prioritize mental capital as much as financial capital. They do not trade to feel productive. They trade to execute an edge. The market does not care about your goals. It responds only to your actions. If your actions are impulsive, your results will be random. If your actions are disciplined, asymmetry appears. Low-risk, high-reward trading is uncomfortable because it forces ACK. Accountability. You cannot blame volatility. You cannot blame news. You must own every decision. The market is neutral. Your behavior is not. When traders lose discipline, they call it bad luck. When they overtrade, they call it experience. The market calls it opportunity for someone else. Every high-reward trade is funded by someone who took unnecessary risk. Do not be that trader. The hardest part of low-risk trading is inactivity, sitting out, waiting. Doing nothing feels like failure to an undisciplined mind. But inactivity is a position. It protects capital. It preserves clarity. It keeps risk contained. The trader who understands this stops fighting the market. They stop chasing. They stop forcing. They let price come to them. Low risk does not mean timid. It means controlled. High reward does not mean aggressive. It means patient. The market does not reward intensity. It rewards precision. Every day you avoid a bad trade, your edge strengthens. Every day you force one, it weakens. Low-risk, high-reward trading is not exciting. It is effective, and effectiveness does not need constant validation. The trader who survives learns to wait. The trader who waits learns to win. The market does not defeat traders. Their impatience does. Your greatest enemy is not volatility. It is the urge to act without reason. Control that, and risk shrinks. Ignore it, and reward disappears.